Four major markets break out and hit all-time highs, shattering bears' dreams. Fed cuts interest rates by 25 basis points, and we live through the scariest words out there alive. NVIDIA injects $5 billion into Intel, what this means going forward for all technology. Dow hits a record high, even as gold breaks out to new highs. Why the VIX continues to stay near lows. 27.5% of you do not subscribe to this channel. Please click subscribe, all notifications. What we go over here is extremely timely, and I do put out small clips, and if you're not subscribed, you will not catch those small clips intraday. Uranium is breaking out, but how long can this continue? Let's get to it. Now, I think it'd be helpful to just take a step back, and what usually happens here is what I like to call forest through the trees. Everybody gets caught up in the minutia, and we start looking at things, trying to decipher. But when you step back and you look at how things are actually going, you get a much clearer picture here. And so there's about 15 graphs here that I think are pretty telling, and it shows exactly what's going on. So this is obviously when we had our sell-off, we go into the election, we have the election, we rally back up, we pull back to that level, then we rally back up, then we get all our winning and liberation out of the way, and then we pause the liberation and winning, and now we're back to breaking out. Meanwhile, all these deals are going on. And I think this is very important because people will not really look at the Dow, but the Dow really is the fabric of the country if you think about it from an industrialized standpoint. So I do like looking at it, and I do find that it's helpful. Am I looking at it from a broad sense? No. But if you really want to look at the just overall health of the economy, you look at the Dow. It's pretty interesting how it works. And I think there's a couple key things that I would take from this graph. First, if we just take a look from August on, just straight out August, every Monday we're opening and every Friday we're closing higher. So from August on, no matter what we're supposed to be told that September is seasonally weak, this is seasonally weak. This is why I hate seasonality, because it's nonsense. But because you're blending together. You can look at it from an election standpoint, but when you start trying to say that every September is going to sell off, it's just silly. But if we look at what's going on here, every week we're up. We're opening on a Monday, closing on a Friday, and you're going higher. Very simple. Don't overthink it. Now, if we take a look again at simple things, like just look at the RSI. Is this extreme? Are we getting out of the way? No, it's commensurate with the movement that we're having, meaning it's following exactly what it's supposed to be doing. And we're seeing this everywhere. And I don't want to spend an inordinate amount of time on the NASDAQ because there's more to look at. This was my target level, which we just went through like butter. It was 600. Give me these weird prints, but it's commensurate with our movement. So even if we take a look at something like just the NASDAQ, and we should look at the NASDAQ next generation as well. We hit a level, we held that level, and all we've done since we held that level was break out of that level. So there's two ways to monitor where this is going to go. For me, there's a call wall up here, and we hit that call wall, and we stopped dead. And that's great. But the other thing that you can always do to measure how that movement is and where you are with that movement is just go here and then just drop it from the base. So in other words, you have a little base right here, and then you just drop your fib levels down, measure it, and it'll tell you where the fib extension is. Simple enough, and that gives you a pretty clear read on what's going on out there. Now, why is this important? Because it can just give you really quick little mini reads. And if you want major reads, you would take the swing low and the swing high and measure from there. But what is this telling us? We're just jugging along, not a care in the world. Meanwhile, we're waiting for this shoe to drop, or we're waiting for something to fall apart, and we're not seeing that. If we take a look at what they refer to as the juniors, but I refer to them as next gen is killing it. So does that matter that next gen is killing it? It does. I'm just going to show you something. I'm very big on relativism, meaning how are things performing relative to something else. And I found great value in this in 26 years of doing this. So I'm just going to share a couple quick things with you. Down here are the juniors. Down here is the NASDAQ. So all I'm doing is taking the juniors, and they call them juniors because of that, but they're really the next gen versus the Qs. And the correlation is when we bottom. And I just find this so fascinating. So what you'll see here from when they actually started the juniors over, you'll see this huge rise. And then you'll see a dump. And people would say, oh, well, that means that when you dump, that this is going to come in. No, it's not really what it means. What this is telling you is when this rises and this starts to rise and it's bottomed, that you're going through a cycle. You're going to go through an up cycle. So when the juniors lead, you're going to go through an up cycle. That's what it's telling you. It's not telling you that when it drops, that the market's going to drop. It's telling you that when you're going through an upcycle or you're going to start an upcycle, this will lead for a period of time and then it just levels off. And you'll see it over and over again, lead for a short period of time and then it'll level off. Lead for a short period of time, levels off. Did the market drop? No, market ripped. So even as this is falling on relativism, if we look at these areas in here where, oh, look, it starts to lift, what happens? Market bottoms right into that August 24 level, and then the market rips. I'm using the New York Stock Exchange. You can use anything, but I'm using a broad base. So even in this little area, you could see that the market dips and then goes higher, and we can blow this up a little bit, but we don't really need to. And this is where it gets so interesting to me. Look what it's doing here. It actually bottomed right in here. So it's actually telling us that this August 4th was a bottom and now we're leveling off. So what does this mean to me? It's actually telling us that the stock exchange is about to go higher than the New York Stock Exchange. So that's what it's telling us. And so when I start going through this and I start looking at the new highs and the new lows and I see people kind of freaking out over it, and I understand why, because the movements are a little stronger than we're used to. But if we go through this, watch, this is next gen again. And this is a chart where I just call it the four horsemen. And you guys always ask what it is. It's very simple. This is MACD, and I get rid of the histogram on here, and all I have are just the lines. This is rate of change. And you can always see when these flips happen. The flips always happen. The best flips, and this is a weekly chart. That's why I have the date up here in the weekly. They always happen when you flip that zero line. Anytime you flip that zero, and this is just a straight out 12 SMA up there, you should use what you're comfortable with. And then I just have the slow stochastics down here because it just smooths everything out. And as long as these four horsemen are aligned, you're set. Now, if I look at this, you're setting up to go a lot higher. But what's so fascinating to me, here's the weekly. You're setting up on the weekly to break out and hit all-time highs on the next gen stuff. At the same time, the NASDAQ's lifting as we went through previously. But what we're seeing is we're not seeing anything extreme. In other words, the rate of change is not just, oh, spiking and dropping. No, it's just super smooth. Even if we look at the RSI, which is getting up there, but this can stay up there for a very long period of time. Watch when we just drop this to the daily and then we'll get right back on it. Look at this and how just smooth this is. So as we're out there looking at this stuff and saying this is going to happen and that's going to break, and what about these numbers? What about those numbers? What do we really have going on here? Consistent buying since we stopped all our winning and liberation down here and paused tariffs, right? That's a joke if you can't pick it up. But so what does this mean for us? It means that they're buying the next gen. And as long as they're buying the next gen, we're in good shape. And the relativism between the next gen and the old staggered kind of Google meta names, as long as that relationship stays the way that it is right now, we're in really good shape. Now to hop right back on and start going through these charts. And I think that these charts paint a picture of what's really going on. And it's been a while since we've just gone through the charts and really taken a hard look at them. So I really wanted to focus on the technical aspects. I do want to go through smart money, dumb money with you guys today as well. And I think we should talk about interest rates and what's happening out there. But this to me is really important. And you got some really big news, in my opinion, on Friday at the close. So we'll get into that as well. But if I look at IWM right here, and this is the weekly, and here's the date of the recording of this, what do we see? Well, we see we got to the doji, and then we stopped, right? Dojis are what? Signs of uncertainty. Is this something that we have to worry about? I think you should worry about it because you got all the way up here and then you stopped again. So does that mean that we're going to stop? Well, this is when we look for signs. When I don't know what I'm doing, which is pretty much all the time, I take a step back and sometimes I'll just flip to an open high-low close and want to look at exactly what happened in these areas. All right, we came up, but they popped us over on the weekly, and then the Monday we sold down. So if we pop over and then we can't get above Monday's level again, that would tell me something. So what are you to take from this? People always ask me this. If you pop over on Monday and Tuesday you sell down, you probably want to mark off Monday's level. That's what I would take from it. If we pop over on Monday and we can't have follow through, then we probably want to pay attention to it. Just like it would have benefited us to pay attention November 21st when this happened, or pay attention back here November 24th when that happened 3 years later. Isn't that a weird coincidence that it happened in November again? So here we go again. But what is this one telling us? Well, that's a new closing high. And if we understand that, you have a new closing high on the weekly. So sometimes it helps me to just get through all the noise, all the minutia, and just look at open, high, low, close. Other people use all kinds of bars. Some people love using these ashy bars. You should use what you're comfortable with. I like the candlesticks because I consider myself a pattern trader, and I really like piercing patterns, and I like encompassing patterns or engulfing patterns because they tell me what people are doing. And To me, candlesticks are the best because they just chart human behavior. And I don't feel open, high, low, close does that. That's why I use candlesticks. But you should play around with all of these and you should find what you're comfortable with. Some people, I have a friend that uses point and figure. They literally do it by hand on graph paper still to this day, and they absolutely slaughter it. So don't just do something because everybody else does it. Try to understand what these things are saying. The more you understand what this bar actually is doing, and the better you're going to do. Don't look at any of these indicators or oscillators blindly. You should be looking at them and going, well, what does this thing really mean to me? Like, what's it really telling me? There's so much value in that statement. I can't tell you that. When I look at people and they tell me that, oh, they don't use RSI, to me, it's like, why wouldn't you if you really truly understood what it was? Or when people look at like the Ichimoku cloud, which actually was like my best video ever, and it was before I even knew what a thumbnail or a title was, those kinds of videos, like they killed it. And people are like, oh, I tried it for a weekend. Well, it took the guy 30 years to build. So maybe try it more than a weekend. So see, I sound so angry. XBI weekly, and then here's the date. And I just think it's worth pointing out because here's our level, right? Here's our zone of resistance, and we're coming into it again. Now, is this going to move or is this not going to move? I don't have a clue, but here's what I know. This is not going to break. I mean, you're going to need something massive to break this. So if you were somebody that was saying, hey, I'm a long-term kind of person, and that's really important as well for those that are investing in trading to determine your time frame. And we're going to spend a little time on that. But I would certainly be putting an alert down here that I would leave on forever and saying, hey, when you get down here, let me know because it's time to, load the boats. The idea that you're going to break this level, man, that's going to be one heck of a level to break right now. And we can see this base. So what we would also take from this chart, and the reason I'm saying this is your comments. Some people will say, well, I don't understand what I'm looking at. Could you explain it a little bit more? And I do read all your comments. Someone asked me the other day to start doing, talk about taxes and structures of, their trading accounts. And I'm not going to do that because I'm not an expert in it. But I'm probably going to have somebody on this channel that is an expert to explain this stuff. Because I do think it's helpful for you to understand structure and the taxes, but I'm certainly not an expert, so I'm just going to bring somebody to do it. I plan on doing some interviews. I think it'll be a good thought. Anyway, I think it'll be a good experiment. Anyway, if we take a look at this area, we would argue that we have a base right in here, don't we? All right, so we're just not ready for prime time. Does that mean that we don't pay attention to it? Does that mean that we don't care about it? No, we're just not ready for prime time, and that's okay. So what we do is go up here, just pay attention to that, and maybe they'll let me put a little alert right there. Maybe they'll let me do it over here. There it is. Yay. And then we just put that little alert right there. And then when it gets up to there, all right, let me know. Until then, do I need to get involved? I think you're in no man's land here with this. I really do. If I go and take a look here again, and something like this, you drop in the 4 horsemen and go, well, what are you telling me? Well, you're breaking through the zero line. The rate of change is above, and we're not pushing through yet, and the stochastics is up. So one could actually argue right now that I'm wrong on waiting. And so, well, why would you say that? So if you know how to use MACD correctly, one of the big times to use MACD is when you're flipping the zero line. And so if you went through this and marked off the zero lines and the zero line breaks over, you would find that that is usually when you start seeing new trends come out there. So what you might want to do is then say, look at the biotech index and what happens when rates drop, right? That might be something for you to look at and say, oh, if XBI goes higher, then is one of the factors, rates dropping. And then people would say, well, why is that? And I'm glad you asked. For our purpose, understanding what the MACD is calculating, understanding what these things that I just showed you are calculating, and not blindly taking what I just said as, oh, I'm just going to wait. You might not wait. You might look at this and say, I think he's wrong and here's why. And this is another really important fact that people need to get through if they want to be really successful at this. Biotech companies borrow money because they have to go out there and develop drugs. When they go out there and borrow money, it's important for us to understand that the cheaper that they can borrow money, the longer that they have to develop those drugs. That is called their burn rate. So you can always look at a corporation and their burn rate and then kind of figure out where you're supposed to be. Why do you care about this? You care about it because when they start cutting rates, the burn rate's slow. Those burn rates are why people will start buying biotech. So if I take something that's more of a short-term interest rate borrow, it's like the US 2-year, which is a really good correlation, you'll see that sometimes it takes time for it to catch up, and other times it's almost instantaneous. So in something like this, you will see XBI climb that wall, and then all of a sudden, you'll just start seeing those peaks. And then as it's coming down, and the burn rate's increasing, you'll see a drop. But then when you're peaking, you'll see the bottom. And it's not once that this happens. It's pretty darn consistent. So you'll start seeing those bottoms, then you'll start seeing the rates drop. And then you're really putting a bottom in biotech when that happens because they have longer burn rates. And it's not just a function of that, but that gives them more time to develop the drug. And that's really important. So you can actually see here, this is the pandemic, and obviously we know what happens. But you can see what happened here with peak. And then as that peak goes along, what starts to happen? Well, they start raising rates. Well, what starts happening? And then, of course, the market's a discounting mechanism, so it's always going to find that, quote, bottom. And you can see it right here. But what's happening here with the 2-year again? Well, the 2-year peaks. What happens? XBI puts in a low. And it's not like once that you're going to see this. You're going to see it all the time. So you just want to watch this extremely carefully and pay attention to it. And these correlations make all the difference in the world, but it's the understanding of the correlations that makes the difference. If you just look at it blindly and don't understand what it's truly doing, you're going to be left behind because it's the comprehension of it. I can't press that enough into you. I was very fortunate when I was taught this, back in the day, that they really hammered in. The guys that I was with, they were like really old timers and they were doing this for decades before I even got there. And what was just fascinating was their why. They wanted to know why something was happening. It's fine. Like you'll hear people say, oh, just follow price. Okay. So if you just follow price, that means that all anybody ever has to do is look at a chart. Well, that's not the truth. You want to know why price is doing what it's doing, because then if it pulls back, you'll know if you're supposed to be adding to it or getting out. So there's definitely something if you're short term, the more short term you are, you care more about the technicals. The more longer term you are, that's definitely something that is of interest. And I'm going to walk you through this later because it's that understanding that can make a huge difference in your performance. And I'll walk you through something I'm working on because I find it fascinating, but you want to understand why it's happening. So like if we look at the SOX and we see this breakout, it's like, oh, SOX is breaking out. I'm just going to just follow price. Okay, you and everybody else. But what's really the driving factor? Because if you understood the driving factor, you can benefit from it, right? So if you're in the community, you know that Samsung just went back online and you understand that Micron, that's why Micron is rocking the way that it is, and Micron exploded to the upside, right? We got involved in this in like 118, 119, still in the partial of it. I did blow it out when we were up. I blew out a big chunk of it when we were up like 45 or $50. So you'd understand why that's going. You'd understand why SanDisk is doing what it's doing. Let's clean this off. That was just me explaining things to people in the room. But if you'd understand why SanDisk is doing this, it's not froth. It's that people don't even understand what SanDisk does, right? You'd understand why ASML is breaking out. And I'll just save you a bunch of time. ASML is breaking out because Samsung just went back online because they achieved a level of success that's going to get NVIDIA back on board. By the way, ASML is the only company that sells the products that's going to need for Intel to create the foundry that NVIDIA just injected $5 billion in. So do I want to be dumb or follow price? Or do I want to understand why this just moved and understand that this quarter of earnings that's coming up? I don't know. Maybe their bookings are going to go up. Maybe that's something that I care about because that's the stock moves on bookings. See, the more you know, the more deadly you are, right? Because when people are getting out of this stuff because it's puking for one reason or another, you understand what it changes and what it doesn't change. And this was drilled into me over and over again. And it was something that I'm like, oh, I get it. Okay, I care about the price. I definitely want to trade the price, but I really want to understand the nuance and why things are doing what they're doing. If you look at the SOX, it makes perfect sense why the SOX is doing what it's doing. It's not froth. You're going to have more demand across a broad base of product. That's why you're seeing the names like KLAC break out because they are the semiconductor equipment manufacturers. And you're just going to see it all over the place. And they're going to move. This is me yelling at them in the room, calling situational awareness. But you understand why this stuff's going to move because they are going to get huge contracts because people are going to start buying ASML machines, which are basically a $400 million computer that shows up, lithography machines. What do? I don't know. They make AI chips. Maybe that's something you heard of. Maybe that's something we should be paying attention to, right? They come with their own engineer. So the more you know. I can't stress that enough, guys. I'm going to yammer on about it in this video, so get used to it. XLP weekly. I'm going to start working in some of the educational stuff with the informational stuff because I don't have time to create separate videos all the time. XLP weekly. What's this telling you? Are we risk on or risk off? Okay, wants versus needs. Why do you care about this? Because if you have XLP and XLP is rolling over, these are my needs. I need soap. I need Clorox. I need toothpaste, right? That's what's in here. Costco's in here. Walmart's in here too. But this is really wants versus needs. And I'll explain that. You need these products. So if I know that I need something consistent that I must buy, this tends to rally in bad environments because people are like, well, I know I need this stuff, so they're going to buy their needs. What you see here is you start to see them getting out of what they need. And what they're getting into is what they want. And when we've been hearing about the death of retail ever since our winning and liberation back here, and now we start looking at the XLY and we're looking at this and going, okay, well, to me, we're at all-time highs. So where's all the death and destruction in the retail department? Because we haven't seen it. And this is what I'm talking about, that understanding. That understanding allows you to get into names like AEO and everybody's puking it at $12. And now where is it? I think you're what, it closed $18, $19. And you're seeing this everywhere where these companies are trading at 8 or 9 times earnings still because people don't understand what really happened here, right? And of course, you can also just take a look at what's going on out there if you want to follow what's going on with the cruise lines. And I always find that so fascinating. Not that I want to be on a cruise ship, but if you always think about this stuff and where you were and where you can go, this is when they were calling them floating petri dishes. This is when you're up 11x your money. It took you 5 years to understand that the floating petri dish was not really a floating petri dish, but just a gold mine floating in the ocean, right? And you'll see this everywhere. It's over and over and over again where you'll see this process, right? Here's $8, here's 30. That one's only 4x in 5 years. Why does this matter? Because when you see this stuff, you could take advantage of it. But when you start seeing the wants breaking out and the needs collapsing, that's telling you that you're not in a recessionary environment. And we can all go out there and say, oh, but this, but that. But they said, or this guy on Twitter, or this guy that lives in his mom's basement eating Hot Pockets said, whatever, man. All I have to do is this, XLP divided by XLY. What's it telling me? They are selling the needs and they are buying their wants. They're going out there and buying their $100 Lululemon shirts. Well, not really, but they're spending. They have money. They're spending it. This is what it's telling us. You can listen to it or not listen to it, but this is what the market's telling us right now. So what I tend to see with these kinds of environments, myself included, is I get out early in these kinds of environments because I'm always waiting for that shoe to drop because I've got hit in the head with that shoe so many times that, you start becoming, okay, well, which way they're going to throw the shoe at me? And eventually we will get clobbered like always. And it will be something that we're not aware of. But in the meantime, this market's telling you that you're going higher. So if I took this and I flipped it, and all I have to do to flip it is go XLY divided by XLP, and I look at how this is playing out, well, does that look like something that's falling apart? Not really. If you didn't know what it was, somebody would be out here saying, well, that's a cup. This was kind of the handle. Now you're breaking out, right? That's what somebody would say if they were to look at this. It doesn't really look like retail's coming to a screeching halt here, does it? These names were super interesting because they're not names that I play with at all. But I think the lithography, I got lithography on the brain, the lithium names, I find this super fascinating because I think this is moving almost as an inflationary hedge. And this boils down to, can you be in stagflation if we are in stagflation? And can the market go higher? I absolutely think you can. And I think certain sectors will go higher, but I also think that you're in a stock correlation market, hands down. And you know what? I should explain what I mean by that. When I say stock pickers market, this is an important graph. So Goldman does this graph, and it's a 3-month realized average of stock correlation. And what it is S&P realized average stock correlation. So how correlated is the market? And you can see these periods of time where it doesn't matter what you do, you're going to go higher. So a lot of people would say, oh, back here, I was a genius. And I don't understand. Why is it not working the same way? Because the correlation, if you take a look at these levels, here's 0.1 on the correlation scale. And then after the pandemic, you're at 0.8. So just to put it in perspective, you were 8 times more likely when you were buying something in here to just win, just because the market was going higher. That's not what's happening now. And so when you start to see these correlations change, and if you're in the community, you saw this graph probably a month ago, but I keep these things because it reminds me when I'm doing these other videos, and I like to review. But when you see this, what is that telling you? You're in a stock picker's market, man. You either accept that or don't, meaning some names are just going to absolutely crush and outperform. And we're seeing that as they cycle through sector by sector when I show you how some of these sectors are performing. You can accept it or not accept it, but this is why you're seeing NVIDIA go flatline for a period of time and going, I don't understand. These other AI names are ripping, because the correlation to the market right now is changing. If I go and show you the performance of ASML versus NVIDIA over the past week, you'd be like, wow, that's incredible, because you would think that NVIDIA would go higher, or Micron versus NVIDIA. When you do these comparison of analysis, this is why. The correlation is at basically decade lows. So you want to look at where the sectors are, but it's not a broad-based buying of the sector that's going to get you the return. It's the stock selection of the name that's in the sector that's going to get you the return. Really important concept, and was worth the minute to cover it. So if you look at the LIT and where am I going with this? Well, there's going to be certain names in this area that are going to break out. But more importantly, is this going up because it's a commodity? I do. I think it's going up more from a commodity standpoint than anything else. I think it's going up for the same reason that we've watched the MPs of the world just absolutely skyrocket here. I do think that that's why the LIT is moving, because it's commodity based. Not that there's this huge demand all of a sudden for EVs. As a matter of fact, a lot of these car manufacturers are cutting EVs or cutting hybrids because they're not getting the same level of interest. Candidly, I think people fall into two categories. They either want the EV or they don't want the EV. But this idea of a hybrid, they were going to kind of ease us into it. Yeah, that's not really happening. Those kinds of cars are losing their value. And you're seeing big corporations just get out of that business and saying, no, we'll do an EV, but that's going to be what it is. And that's all we're going to do, versus the hybrid kind of situation. People are really getting out of those cars and they're losing value. So I think that will continue. But what does this have to do with LIT? This sector is breaking out. And if we look at it from that perspective and do the simplest of things again, what is this telling us? Right? So again, when in doubt, just go to open, high, low, close. Well, you should do what you're comfortable with, but you have a new closing high, and that closing high is greater than anything that you've had in 2 years. And then if we want to just kind of look at how this is setting up, we would see this divergence right here. And, you guys know how much I like a good RSI positive divergence. I know I need a life, but if you see this divergence right in here, it's pretty obvious what's going to happen, isn't it? So from my perspective, yeah, you put in your bottom. Yep, you broke out. Yes, you're setting up to push and go higher. That means that the LIT sector is breaking out. And this is really where our focal point needs to be, because when we look at things like uranium and we're watching these breakouts, and I must have ran, every day I do it, but last night I must have ran about 500 charts and just looked at the market and everything. These sectors are broadening out. They're not pulling back. They're actually broadening out. And I think that's fascinating. Now, is this ahead of itself? I think it's ahead of itself, yes. I think uranium's way ahead of itself, but I'm always early. And I don't mind being early, because it just means that I'm not going to get hit in the back of the head with the shoe, right? But when I look at stuff like this, yeah, I have to really go through it and say, all right, well, what's really happening here? Well, if I go back and look at the MACD, like on a weekly basis, you don't have anything like this. But also, you've never had more demand and interest in these names. But I'm not frothy in here on the rate of change, from the rate of change that was expected in here versus where you are. If I look at the RSI, am I up here in the 80s? Yeah, but it's commensurate with the move. If I take a look at the stochastics, it's turning up. It's not breaking down. I don't have a negative divergence in the stochastics. So while I look at this, and for me, I had a really good trade in this, OKLO, where we actually bought this at 60. We've been in it for 30 days, and this is super interesting. From there, and 60. Now, I always think it's better for me to pull up some stamps here to show the timestamp. So here's the date, August 20th. And this actually was super interesting because we're up 100% in this in 30 days. I went through, this is so interesting, but I went through since the community was created, and it's only been open 3 years. I've been trading 26, but I found that there's a lot of correlation between when these things go up 100% in 30 days from the date that we buy them and what winds up happening to them. And the commonalities between those names is fascinating. So I'm probably going to do a whole video on that. I'll tell you what some of the other names were. PLTR, we had a double in 30 days. PINs, we had a double in 30 days. APP, we had a double in 30 days. Not all this year in previous years, but they were all when they were in their infantile stages. What bothers me about this name is I have no revenue. So it's very hard for me to argue about whether this thing should be $12 or $400. But I just want to show this before I go any further, because this is what, people are saying, oh, we're up a buck. Are we trimming it? And I'm just saying, hey, it's not, because we just nailed it. And I'm like, hey, it's not a day trade for me. I'm staying in it. But now you're up 100%, but it's all management of the trade. So what I'm trying to do with some of these names, like here, we're up 30 points. I'm just raising the stop up. So one thing that people tend to not do with these kinds of trades is quantify what they're willing to lose. They tend to not do that. So you can see as it's progressing, I'm moving the stop up, right? I'm up $40 here. What am I doing? I'm moving the stop up. And then when it finally gets to an area where I want to do something, which was yesterday, it hit a level or on Thursday, it hit a level and I looked at it and just said, man, I'm definitely doing this. I'm all over this. I'm taking my $50. I'm getting out of a chunk and I'm going from there. Now, most people would look at that and go, oh, but if you held it, you could have done this. You have to quantify your risk the whole time. Like, what if it all of a sudden dropped like $30 or $40? So the other thing that I'll do is I'll go out there and I'll hedge with puts. And I definitely am going to do a video on this because I really feel that people are doing this wrong. Eventually, what you're going to see with these names, I bought the 120s for $2. I was just leaving these puts on. And I actually bought the 125s. And I had a ton of these puts yesterday because if I dropped and reversed after quad witching, man, this was going to be brutal. It didn't crack, but we were up 100% and we trimmed it. I'm definitely going to do a video, I think, on the commonalities between APP, OKLO, pins, PLTR, and why they're doing what they're doing, because I don't think people understand that there are commonalities here. But here's the point that I was getting at with something like this. You look at Friday and you go, okay, you opened at 110 and you ripped. And people would say, oh, well, you lost money on those puts. You don't know you're going to do this. You are trying to put yourself in front and get on the right train, but you don't know it's going to happen. So you need a process, right? And that process, to me, is what defines you. If you're selling here and you're trimming here, which I did, it saves you from not trimming here, right? And that makes all the difference. So you always are looking for that positive slippage. So I always tend to get out early. I'm fine with it. I don't need the last dollar. I've learned that a long time ago. If I buy things here and I'm getting out in here, I'll be very happy with my life. And it served me very well. But the purpose of this video today is to get us through and look at what's really going on out there. And in between that, I am weaving how I trade and also a lot of the educational stuff. So if you can comment on that, I think it's super helpful because it shows not only just regurgitating the information, but I like to show it in application. And I think it's a great way to do this. So let me know in your comments. Also, let me know what other kind of videos you want to see, because I do think I'm going to start creating different kinds of content. But on these Saturday videos, I really want to weave this stuff in because I do think that these tips can be helpful. But if we get back to how we started, it was all about what's going on out there. So far with what we're seeing, whether we've looked at the Dow or we've looked at what's going on with XLP or we've looked at some of these relationships, all we're seeing is broad-based buying throughout various sectors. And so for us to look at this and selling the defensive sectors, and for us to look at this and try to call the top is a fool's game. It's over when it's over. It's like trying to call a bottom. You never know where it's going to be. You try to time them. I do it all the time. Sometimes I catch them, sometimes I don't. But that's not where you're going to make the majority of your money. Once it's confirmed and there's a possible bottom like this, then you might be able to benefit greater from it. And you can always try, right? But just understand that that is going to be, pretty much a losing game. If you take a look at something like Block and the way that it's breaking out here, again, if you go and take a look at what's really in Block now, it's not the miners as much anymore. Some of them, of course, but you're seeing stuff like this CIFR is in there. Galaxy is in there now as well. Some of these names that we've gone over in these videos before, this one at like 19 when they did a secondary down there. And the function of this in showing this is these kind of sector funds are getting out of the game, meaning they're no longer buying these little crappy companies and saying, oh, buy this because it's going to do that. No. They're buying real companies. Block's buying real companies. Block top 3 holding is Hood, to put that into perspective. And, I'm going to do this at the end of this video. You might want to watch this on Monday. You had huge buying in Hood and you had huge buying in APP because everyone knew that they were going to be added to the S&P. After everybody knows the same thing over and over again, what tends to happen? Right? If everybody knows something, who's left to buy? Just FYI. But in regards to Block, what is this telling us? It's telling us we're going higher. right? It's telling us that the market is going higher. Very clearly that you're breaking out. And I would spend some time looking at these holdings. It's the same thing that we saw with QMTM or QNTM. That's not it. Hold on, let me find the right one. QTUM. If you go and take a look at this, go look at the holdings. The holdings all shifted. Now you own IBM and you don't even know it, right? They're building these things out. And now why is this good? I'll tell you why it's good. Because it creates more broad-based buying. Because if the underpinnings and foundations are good, then you're going to go out there and buy the IONQs along with it. Right? That's where the metal comes in. So if they have real companies there, then and they also add the speculative excess to it, then it does its job and it adds stability to the market instead of volatility. This is also another reason why I think you're seeing the VIX drop that nobody's talking about. And I'll explain in a minute. There's so much I want to go over with you guys, but I do want to segue into this. So people are looking at the VIX and going, why isn't it falling off a cliff? Blah, blah, blah. The stability on what you're seeing via the ETFs and what they're doing to the market, that stability in the way that they're going out and diversifying through major companies is actually causing the VIX to stay a little stagnant. And I know people aren't going to get this, but I'm just going to explain it. When you first started buying quantum, you were buying, these were your holdings, QBTS, QUBT, right? All these names that are flying now. But when you were doing it back here, back in the day, you were falling apart. You'd go up to 27, you'd be down at 4, right? All of a sudden, you don't have that instability. So the stability that you're seeing in the market is what's driving it. And it's the equity side of the market. The other thing that's driving the VIX down is now you have complete stability in the environment. Economically, you do. So how? You know they're going to cut rates. You know rates are going lower. You know that means the equity risk premium, which we've gone over in several of these videos, is going to be more favorable towards equities. So you know, unless there is an escalation of war or an escalation of tensions between countries, what is really going to get the VIX? Nothing. There's nothing out there that's going to do that. And I think that's very important for us to understand. As a matter of fact, to segue into this and move it along, if you look at the dollar, which I wanted to go over, you have your little doji down here from June. You hit that level again and you held. And I left this little note for me because I've been prepping for these Saturday videos so that, a lot of this stuff's off the cuff, as you can tell. But what I'm trying to do is I'm trying to segue into these things. So I'll leave myself little notes. But if you look over here, watch. And so here we are in that 99, 91, 95 area. But what do you notice about this area if you really drop this down into here? Test. Rallies, test, 95. Well, what happened in February and July of 95? And I've been telling people for a long time that this is kind of what's happening to us now. And people are like, no, you don't know what you're talking about, boomer. That's what they sound like. But in this area, everyone's like, oh, well, the dollar's dropping. And no one cares. Like, no one cares. All of a sudden, everyone's a macroeconomic dollar expert. Here's where the dollar was in 95. When the dollar started to rally up into this, that is when you had the single greatest event that you could have made money in the stock market, period. End of story, right? So when everyone's like, oh, the dollar, and like here we are again in 21 and the dollar is ripping. Did this have any correlation to the market? Some. Sure, of course it did. Same thing here. So it depends on the environment. If the productivity and money is going to be flowing easier, then yeah, you want the dollar to rip. If the productivity and the financial conditions are about to get tighter, no, you do not want the dollar to go up. Right? This was easy money, right? This was not easy money. This is the Fed looking at what they did and said, geez, maybe we shouldn't have injected $1.7 trillion in the market. People are buying JPEGs and calling them NFTs, right? Okay, so you're sitting in here and you're holding, and that's exactly what you're looking for. This is why industrials are so interesting. If we look at TNX, which I think is important, because this ties into why gold's doing what it's doing, and it also ties into why the home builders are doing what they're doing. So everyone thought we'd break 4%, including myself. We did not break 4%. And if we take a look at what that led to, gold. Why is gold going higher? Gold's going higher. I measured the fib levels right here, and what we're seeing with that and these fib levels, really simple stuff, very, very simple stuff. And I want to just go through this very quickly. That measurement from here down is telling us that that's the next fib and that's the next fib. You're flipping. I think the stagflation argument is a real argument. I do. I think it's a real argument. We seem to be just okay that, 3% inflation is a thing. And that means that everybody that works loses 3% of their income every year. It's not okay. Like, I'm not going to get on my Boston Tea Party kick here, but no, it's not okay that we're losing 3% every year, but it's an issue. So how are you going to hedge that issue? People are going to hedge that issue by buying gold if they know what they're doing. they're also going to buy that and hedge that issue by buying Bitcoin. Hands down, they're going to buy those two. And I don't think that's going to stop. I also don't think with the massive amount of debt that's going on out there right now, that they're going to stop buying gold, the massive amount of debt that the US has. I don't think that anyone's going to stop buying gold. I don't think that any country is going to stop buying gold. I don't know about silver. I'm probably the worst person to ask. If you had to say what is the thing I trade the worst, it's silver. Now, ITB, what does this mean? Well, we probably got ahead of ourselves and we're probably pulling back and then we're probably going to reset. And that's how I feel about ITB. But the thing that you should take from this video more than anything, and I do want to go through smart money, dumb money with you, but the thing you should take from this video more than anything else is that you are broadening out into growth sectors and you are dumping the defensive names. That is what's happening. Does that continue forever? Probably not. But the thing that you should be thinking about is, and understanding all of this is, tell me what derails us. What is the thing that's going to derail us? I'm all ears. Is it something where the economy is going to roll over? I keep hearing about these loan securitizations and seeing this stuff. See, like everyone's like, oh, well, the loan securitizations, they'll look at like zero hedge, which does a good job on some articles. Don't get me wrong. But you could take these graphs and make them anything that you want. I mean, you're only using from August 25th this over. And we're like, oh, well, they're all breaking. Those auto securitizations, they're having their Lehman moment. Well, maybe somebody shouldn't have bought like E-rated paper. I don't know. Just call me nuts. Maybe just don't buy that paper. That might be a good idea. There's a reason you got the yield that you got, right? But if I'm looking at this, does it look like the market cares? Does Carvana care? And people are like, well, Carvana is a fraud. Okay. Does it look like AutoNation cares? Like nobody cares. And they're going to care. I've been hearing this for over a year. And what people don't understand is that default rates drop when they move rates down. And we know they're going to drop rates and they're going to do it consecutively. We're not going to get into it in this video, but I will cover it in another video. They're going to drop rates consecutively. And when they do that kind of thing, that helps that level of the market greatly. That's why you're seeing MasterCard do what it's doing, where it's holding in here, or why you're seeing Visa do what it's doing, or why American Express is breaking out and raising their card fees. If things are going bad, American Express does not raise their card fees, right? Just think about it from that perspective. It doesn't make a lot of sense. Now, in front of us is smart money, dumb money. And we do not call it that. We call it retail and institutions. And there's a reason for that. And the core reason for it is because smart money right here and dumb money right here, they total things. What do they total? So institutions, this determines the net flow of both. And just for a refresher, people always say, you don't have to go over this every time. Believe it or not, new people watch these videos. And I do want to spend a second on this, just a refresher. Just think about this as net flows of retail and net flows of institutions. And if you think about it that way, it makes more sense. But retail tends to move super fast if they want out. And then institutions take their time. What we're seeing right now, if you get that, so whenever you see retail push and institutions dump, you want to pay attention. Whenever you see retail getting out and institutions buying, it always means, not sometimes, it always means when you see that, retail's puking and institutions are getting in, it always means that you're going to see an environment, I hate saying always, but retail moves so fast, they just want out. Just get me out. Those inflection points, you go down and you just do. It doesn't mean you're going to drop like really far, but you will drop and there will be some kind of drop associated with it. It's just the way it is because they are going to allow you to get out as fast as you want. And then they just pick up the pieces. They're in no hurry. They have infinite funds. This is what people always forget about with smart money, dumb money. Institutions have literally infinite funds. What are we seeing here? And what's important about this graph? The most important thing to me is the levels that you're holding. And I'll show you what I mean by that. If you just come across from this over, you're going to see that between May, June, July, let's just take June and July. We're going to dive into this in a second. You do not have the same level of equity exposure right in here of net buying that you have on the institutional side that you do on retail. And retail's not going anywhere. Just to be really clear about this. This is why I like doing it as smart money, dumb money. Retail's not going anywhere. They're hanging in there. Super important to note that. There's a spread between these two. I don't feel the need to do the spread right now because nothing's changing. Now, has something changed in the market that would allow this to happen more than it's really happened in the past? I would argue no. I would just argue that retail is feeling some kind of way about the market and institutions are as well, but they're not really aligned. And what you're doing is you're getting this gap. The nice thing about this gap, and I'll show you this on a smaller time frame, is that it gives us massive flexibility. Now, by massive flexibility, it means that if retail's not in a position that they're going to get out and institutions are not in a position that they want to buy, from an investing standpoint, it gives us a lot of flexibility, meaning if retail's not going anywhere and they're not going to be the ones to sell and institutions are not overweight, well, institutions eventually are either going to do one of two things. They're either going to dump. And if we look at what happens when institutions dump, retail tends to step in. If they're going to do that, then that means that we're probably going higher. The other side of this is that if retail holds in here, and we're going on that assumption, institutions are going to have to step in. You see, usually when this happens, you get this kind of inflection point. And this obviously is when we got liberated and all that winning. And when we broke down here, you can just see how we lifted, right? It's no different than how you broke here. And then all of a sudden you start lifting and then institutions like, well, that's enough. And then retail's like, no, we want more. And so you can see the turn of events there, right? Right now, you're getting a flat line. That flat line to me is super important because that status quo is holding. And in one of these future videos, probably next Saturday when I have the time, we used to go through this graph a lot called the last hour. For today's video, I'm not going to have time to do it. But you are seeing, and I'll just get to it, you are seeing way more interest in the ends of the days again by institutions, which could lead to seeing something along the lines of something like this, and then retail still staying flat, which could put more demand for equities in the market. See, when you cut interest rates, you should see more demand from institutions because the equity risk premium flips. And we'll get into that in another video. Some of you guys have already watched those videos, but I'll cover it again. One of the most exciting parts of the market for me this past week was just watching how software is starting to get into the AI space. And we're seeing new products come out of Crowd. And this is exactly why Crowd did what it did and lifted. It looks like it's going to rip everybody's face off. And then, not to be outdone, we started seeing some secondary names that are very similar, starting to move a little bit here, like CDNS, SNPS. They really seem to be benefiting from this news. And if you look at that, I think it's a really good sign that software is getting back into this game and finding their place in AI. You might want to watch these names. The other thing that we're really starting to see, besides that stock correlation that we went over, if you start looking at the drone space and we look at the UFO, and I would focus on this one, but you could also go through JEDI and see what's in that one. But that is a UCIT, and so it's not US based. But if you go and take a look at these names, I'd go spend some time on this. Because these names, and I didn't want to go through all these sectors because we can only do so much, but some of these names that we've been in for a period of time, like KTOS, some of you guys have been playing AVAV, these names, they all look like they're going to absolutely just rip. That space is getting a lot of attention, and I really don't think it's going anywhere anytime soon. I think focusing on these names, what could be the new leaders versus saying that we're going to sit here and keep trading Tesla around. And don't get me wrong, this looks like a perfect little flag, or that NVIDIA is going to go higher. It falls back to what I was saying earlier. If someone goes, here's Micron, here's NVIDIA, and we were to look at what name should you have owned? Well, this is what I mean when it starts boiling down the stock selection. And you want to follow where the money's going, right? Because if you were buying Micron and shorting NVIDIA over the past month, you're up 47%. And we can see these percentages and changes in this kind of market. And that's what makes it a stock picker's market. That is it.